What is really going to happen in the residential real estate market? Stay tuned. Welcome to this week's edition of Note School TV. Well, where every week when 11:05 Central Time on Wednesdays, we bring you the most amazing guests and the most amazing content. Today, we have both. We have a great guest with great content, and we will get him on in just a minute. But before we do, just go ahead and like this presentation. Yep, go ahead, Bing, hit that like button there. And then if you have not already done so, click on the subscribe button as well so that you will, you'll be a part of the Note School YouTube channel. So you can watch, the last 3.5 years of the content we've been bringing you. And then number 3, hit that bell notification. Yep, Bing, hit it so that you will know when we go live every Wednesday at 11:05 Central Time. Also, make sure and keep those questions and comments coming. Eddie and I, we really appreciate the comments you make, the perspective that you see in your market that you bring to us or share with us. So please continue to do that. It really means a lot. And just share what you have there. And if you would like to know more about what we do at Note School, simply go to noteschool.com/TV. Again, noteschool.com/TV. With that, we will not have a news segment today because you'll see why in just a second. With that, I'm going to introduce our Chief Visionary Officer, founder of Note School, all-around good guy, my friend, Mr. Eddie Speed.
Good morning, Joe.
Good morning, and it's a beautiful day.
It is a beautiful day. You know, Joe, this is my 44th year in this business, and what I learned in the last few years has made it much easier to forecast the direction of the business, the direction of the market, the actions that I take, the cautions that I take, right? Or when I choose to be aggressive. And part of the reason for that is friends like that we have on today. They help me guide a lot of the business and help me be a visionary for Note School, because today we have the Director of Economic Markets for Auction.com, Mr. Daren Blomquist. How are you?
Hey, Eddie. Good to be here.
Hey, man. How you doing, Daren?
You know, I really do. I really am telling you, Daren, we quote you a lot and we pay attention to you a lot, not even in other presentations that we see you do, but you are going to give us an incredible amount of information today that helps guide us with confidence in the market. And that wasn't available 20 years ago, by the way.
No, it's amazing the amount of data and information we have. The market can move a lot faster than it used to because of that. So yeah, happy to share that. And I'll be sharing some of the data we get even from auction.com itself. We're a marketplace that has near real-time data. We're seeing how people are bidding on properties, how much they're willing to pay for properties that are going in foreclosure. So it's really been interesting for me to be here at auction.com and get access to that kind of frontline real-time market data.
Yeah, it is incredible. And we have always really appreciated your willingness to share, auction.com's willingness to share with us. And so we're excited. I don't know how long this program's going to take today, guys, but I'm telling you, if you miss this, you are missing the opportunity of a true industry expert setting up for us the direction of the market. Daren has been on every national publication, every interview with so many national networks. It's endless. He is definitely an industry expert, and we're honored to call him a friend here at Note School. So Daren, we're going to let you have the screen, and we're going to kind of hang out with you, and we'll just kind of engage if there's something that seems appropriate, and otherwise we'll try to stay out of your way.
Awesome. Thanks, Eddie. And yeah, I appreciate you guys so much and your audience. I love hearing when I give these presentations, hearing back the feedback from you guys, because you see a different angle of the market than I do.
Sure.
And so it's always good to have that interaction as well, not just me spewing out the the data.
Yeah.
But feel free to push back even if you disagree with something as we go through this.
All right.
All right. So pretty generic title here, but this is what we're going to cover today. What I plan to cover. Won't spend a ton of time on the macroeconomy, to be honest. I mean, because I think the picture is fairly clear there, and fairly easy to understand what's going on. Macro housing market, and then where we will really dive in is the distress market, really looking at the funnel, where we see stress emerging, foreclosure supply, foreclosure forecast. A big piece of what's happening in the distress market today is government intervention. So we'll talk a little bit about that, how that has changed things.
Yep.
Then equity and pricing we'll end with in our market. So, and when I say distress market, I'll get into that a little bit later, but it's really around distressed loans, and that enters into the auction.com universe in terms of properties that are scheduled for foreclosure auction. But there's obviously other manifestations or other exit points for those distressed loans, which can be non-performing loan sales, reperforming loan sales. So that I think has an impact on a lot of your audience as well.
It certainly does.
So starting with just this is a lot here, but basically I just want to see the color. Look at the colors. There's only two. These are some of the key metrics I look at in terms of what's going on in the macroeconomic universe, and especially as it affects real estate and distressed real estate specifically. And the red is basically bad for the market. Green is good. Yellow is in between. And you see here we have just two reds. They're pretty important reds, but we'll talk about that more in a second. And then you have 4 greens and, if I'm counting correct, 3 yellows. Mm-hmm. So in general, I mean, the high level, just quick glance takeaway from this is that the market is doing very well. And there's a lot of folks who believe the housing market the economy is coming in for a soft landing this year. And there's a lot of things that do point to that. Now and I'll just call out a couple things here, but you look at consumer sentiment, that's very strong. And if the consumer is confident, that is going to drive the economy. And we're seeing consumer spending be very strong. So that's a huge piece. Unemployment, I think that's something a lot of people are aware of, is doing very well. The job market is just outperforming expectations left and right. Home price appreciation, we did see, depending on whose numbers you look at, but we did see a dip in home prices last year.
Right.
But that is strongly recovered, and we're back to good, kind of steady single-digit appreciation in the market. Delinquencies, which we'll talk more about later, are near all-time lows in terms of that rate. And equity, that real estate net worth, is good. We're not seeing big jumps in foreclosure starts, although foreclosure starts have been coming up a little bit, but nothing crazy. And we'll talk more about that later too. But actually, what I want to focus on is the 2 reds there, and because those are the biggest risk to this soft landing scenario that we could have in the economy. And the biggest risk on that first page, I called it the yield curve, and the New York Federal Reserve. That's the spread between the 10-year yield and the 2-year yield on the treasuries. And it's kind of a technical indicator, but it has accurately, when that yield curve has become inverted, when the short-term rates are higher than the long-term rates, then we see a high risk for a recession coming. And that has historically predicted most of the recessions that we've seen going back to the 70s. And the New York Federal Reserve has created what they call, using that yield curve, a probability of recession. And that's the red line here. Yeah. So, and it predicts 12 months in advance. So we're now at 63% chance of a recession in December of 2024. But if you notice, that red line was actually even higher. It was up to over 70% probability of recession in mid 2024. It came down a little bit and has gone back up. But there is this indicator is telling us that the recession is coming. Now, I think a lot of the people who've been calling a recession are now being looked at as Chicken Little, the sky is falling, and it never really does. It feels like we've been calling for a recession for the last 10 years, and it hasn't happened. But we did have a minor recession in 2020, a mild recession. But I don't want to gloss over it, because this historically has accurately predicted a recession pretty accurately. So there is that risk that's kind of looming, despite all the good news that we see coming out in the market. So that's one piece that's counter. And then another risk, and this is more to the housing real estate market specifically, as opposed to the economy overall, but is because the job market is so hot. So we see that unemployment rate at 3.7%, 353,000 jobs were added in January. There's just the news that came out last week. Because of that, in some ways, that isn't evidence of a soft landing, but because you see that strong job market, and one of the key pieces there is that 4.5% increase in wages year over year, wage growth is remaining very strong, and that's going to put more pressure on the Fed not to lower rates, which a lot of folks are expecting the Fed to lower rates this year, because it appears that inflation is coming under control. But that wage growth is an indication that inflation may be a little bit more stubborn than maybe some people think, and that could keep interest rates higher for longer, and specifically mortgage rates in the real estate market, which has been a headwind for the housing market, and is something that's related. When we see those higher interest rates, that does tend to trigger more distress, more delinquencies. In kind of, it's something that folks who get hit with some kind of life circumstance have more trouble getting out of that and avoiding default because of the higher interest rates. They don't have some of those loan mod options or refinance options available to them. So those are kind of two. Even though overall I would say the economy is looking like it's coming in for a soft landing, these are the two counterpoints to that: is the risk of recession and this really still hot job market that could keep inflation higher for longer, and also then interest rates higher for longer in response to that inflation. Just a couple things. There's a lot of data here, but we look at the Fannie Mae forecast and the MBA forecast. Both of those they update that every month. And a couple months ago, they were both still forecasting a recession in 2024. They've now taken that out, and they've lowered their unemployment rate forecast. It's near the bottom for Fannie Mae. It's the highest that they're saying that the unemployment is going to get over the next 2 years is 4.4%, which is kind of crazy. Just a few months ago, they were predicting 5.4% peak in unemployment. Similarly, MBA has tamped down their forecast. They actually are still technically forecasting a very mild recession in the first half of 2024 there, and under the real gross domestic product. But similarly there, even with that, the unemployment rate is going to peak out at 4.7% at the end of 2025, hit 4.5% in 2024, which is still, you barely qualify that as a recession. Historically speaking, unemployment rates below 5% are signifying a very healthy, strong economy. Right. So I'll pause there for a second before I jump into the housing piece. But any thoughts, feedback you guys have on some of that data? You agree?
Well, I mean, we're watching the recession predictions, and we had noticed the same thing and mentioned it on this show that, there's sort of a joke out there that I've heard in the past, and that is, what happens when they miss these projections? And the answer is nothing. So, I know the best they can, and we certainly pay attention to them. I know that a lot of the Wall Street level capital that invest in this business heavily, that was a belief of theirs towards the end of the year that we were probably for sure headed to a mild recession. And it's interesting that number is moving back. And obviously for us, we're not wanting one or the other. We just want to know what happens, right? I mean, we have some different dials we may turn depending on what happens. But when we're buying defaulted loans or reperforming notes, we're not very motivated for us to be in a recession, and we're not very motivated for us to the collateral to go down. So we just are trying to always get a sense of it, and you have such great information. So
I mean, we're in the same boat. Our business would see more volume as a result of a recession and a rise in delinquencies, but we have to plan the business based on what's actually happening, not what we wish for. And but also we can do well in an economy that is strong. There's always distress, and so actually when we see a strong market with that collateral, those values going up, our conversion metrics when we sell these properties are actually much better in that kind of environment.
Totally agree. The equitable foreclosure, we call it, right?
Yeah. So I'll jump into the housing market, and just to look at that, we're seeing, because of the headwind that I mentioned earlier with the high interest rates, high mortgage rates, we definitely saw a sluggish, tough housing market scenario in 2023, where home sales, if you look at for the year, home sales volume was the lowest pace since August 2010 to end out the year. For the entire year, just over 4 million sales, existing home sales, the lowest level in 30 years. And home price appreciation actually did go negative there. This is according to NAR data, National Association of Realtor data. So it was a tough year for the housing market. There's no doubt about it, but you have seen at least prices recover. Home price appreciation now is at 4.4%. Now, one thing I wanted to note, though, is the new and existing sales market is kind of quite a bit different. Yeah. In the existing sales market, we saw that slowdown in sales, but prices continuing to go up. What's interesting in the new home market is you saw sales actually up 4% from a year ago to end the year at 664,000, which, by the way, new home sales are 664,000 versus 4 million existing home sales. So they're a much smaller part of the market, although they grew as a share of the market in 2023 because they grew. But what we see on the pricing for new homes is that we've seen several consecutive months of, and that's the blue bars here, of year-over-year decreases in the median price of new homes. And so, what that tells us is new home builders are more flexible in pricing, and they can build. Yeah. They realize that affordability is an issue, and because of the higher interest rates, and so they're flexible in some of the pricing, some of the mortgage rate buy downs that they're doing. Yeah. And so that's producing more sales at a lower price, which actually, I would, as a market, as someone who looks at as markets as when they operate efficiently, do the best for everybody involved. You kind of wish that for the existing home sales market, that some of these sellers would be more reasonable on pricing, and if they were willing to lower price when they list their properties, you would see a lot more than 4 million existing home sales in 2023. Home builders have been able to be flexible on pricing for different reasons. That means more sales are occurring at a lower price, and they're building slightly smaller homes too, that are a little bit more affordable, and in markets that tend to be a little bit more affordable as well.
Got it. Yeah.
So Daren, we started paying attention to the new home builder inventory after this census report came out at the end of August. Basically, there was almost an 8-month supply of housing, and we were reaching out to a lot of people that were trying to get the best information we could. And yes, the builders were giving a lot of recessions, and they were really seemingly pretty nervous with an 8-month supply of housing. That was way different than the MLS world, right? And so I just was wondering what your thoughts were on that.
Yeah, I think, and here's I have that inventory piece in there, and you can see here on the right-hand side, the month supply for new homes has been hovering between 8 and 10 months over the last couple of years, 8 to 10 months supply, which traditionally 6 months supply is kind of considered a balanced market.
Right.
So there's actually more supply, but that's why you're seeing, I think, that's what you would expect to see in the market behave is with more supply, you get the price comes down, which we saw in the previous slide. But you then the market reaches a new equilibrium, and you actually can have transactions happening, which we're seeing in the new home sales market. Where in the existing home sales market, supply is hovering around 3 to 3.5 months of supply over the last couple of years, and that's resulting kind of a logjam in that market because pricing is not adjusting in the existing home sales market, and that's there's more structural reasons why prices are not adjusting. But in a completely market-driven environment, you would want prices to adjust lower. Of course, homeowners don't want to hear that, and you would then see that inventory loosen up and sales increase. But we're seeing more of that logjam in the existing home sales market, where the new home sales market is behaving more like a classic market environment where prices have adjusted and sales have come up. Inventory is benefiting the buyer in this case in many ways. I think maybe the underlying question you may be getting at though is, are we getting anywhere close to an oversupply of homes? And I don't think I have this slide in here, but I've looked at that. And if you look at household formation versus new homes that have been built, including multifamily and single family, we're still at a deficit of I would say about 4 million housing units relative to the number of households that have been formed over the last decade or so. So we still have what I would call that structural undersupply of housing based on the number of people who have decided to become a family, become a household. And so that is what's driving, I think, part of the existing home sales logjam, is because there's still just not enough homes out there that have been built relative to the number of households that have been formed.
One of the things that it always interests me about the builder market is, when rates were not that high, them carrying inventory wasn't a giant problem. Whereas inventory has, gotten really, if you're taking 8 and 10 months to sell a house with double or maybe even triple the cost of interest, then they've got a heck of a number just in carry cost on interest on these assets. And I just keep thinking like, I'm surprised that they haven't adjusted their production numbers more than they have.
And let me ask this based on that. So you've not only got the 8 to 10 months in the sales cycle there, but you also have another carry, which is from the time they break ground until they finish. And I think new homes are taking about anywhere from 8 to 12 months to to come to market to be built. So then that's a long carry.
That's right. Yeah, it definitely is. And I think that kind of answers Eddie's question a little bit too, is the builders have in the past gotten caught because they've started just going gangbusters on the building and then been caught, with their pants down a little bit in terms of having too much supply and not enough demand. And so they're still behaving pretty cautiously. They definitely have ramped up, and I wish I had this slide in here. They've definitely ramped up housing starts and housing completions over the last couple of years. Yeah. But that hasn't actually if you look at 2021, that was the first year in a while where there were more housing starts completed, housing units completed, than there were households formed. So they actually supplied the market with oversupply in 2021 if you just look at that 1 year alone. But then pretty much all the years around 2021 were an undersupply of homes.
Well, they say it's supply and demand, and the truth of the matter is there is an undersupply, and we can see that in all this data with the built new homes and existing homes. But I've learned something that I don't know that I would have repeated. I would have said the same thing 10 years ago, and that is affordability trumps availability.
Affordability trumps availability. Yes. Yeah. And affordability we have here. And I do think that's a big part of the story. And I think the supply story is not as constrained as it maybe looks on paper because of affordability and the fact that everybody who owns a home and might otherwise list it for sale has to think about, well, what would happen if I did sell this home? I have to find somewhere else to live.
Right.
And I have a 3% mortgage rate. If I sell this home, I'm going to turn around and get a 6 or 7% mortgage rate. So that is creating this logjam to a certain extent of supply, in addition to the kind of structural undersupply that we talked about. Now, affordability is starting to come down. That's that top line there is payment, basically the ratio of payment to income on a median priced home, assuming that whatever the given 30-year mortgage rate is at the time. It peaked out back in mid 2023 at 37%. It's come now down to about 34% as mortgage rates have come down. The problem is because of the lack of supply, that's allowed home prices to go up as well, somewhat counteracting the decrease in mortgage rates. But I guess the positive news here is that affordability is easing a little bit. And then I do think that will potentially create a little bit of a easing on a supply of homes for sale. And we're seeing some very early indicators of that. If you look at this realtor.com data for January, the homes for sale were up about 8% year over year. And so it's obviously very early. To about 3% more new listed homes compared to this time last year. And so that, if we continue to see the mortgage rates come down, which I don't have a lot of hope that they'll come down super quickly.
Right.
But that could ease some of this inventory crunch. At least it won't be as bad as 2023, which is kind of a low bar, right? But at least we're heading in the right direction in terms of inventory, I think. And especially if these sellers are willing to, maybe they're not going to get the price that they would have expected to get back in 2021, but they're willing to capitulate on price a little bit. You could see that existing home sales market loosen up a little bit and more transactions happening there.
Right.
So that's the supply situation. I did want to, just as a side note, the bidders on auction.com are actually very good at predicting what's going to happen in the retail housing market about 6 months in advance, especially in terms of pricing. So if we look at what we call our winning bid to after repair value on properties that are being purchased on our platform at foreclosure auction, that's the green line.
Okay.
You know, to set a benchmark back in 2019, the average winning bid to after repair value ratio was 60%. So people were buying 40% below the after repair value of the homes at auction.
Mm-hmm.
That, that actually went up during the pandemic housing boom frenzy. But then in late 2022, that dropped pretty precipitously, all the way down to 52%. And that was our buyers, who typically are local investors who know their markets very well. They were anticipating that the housing market was going to slow down. And in fact, it did. About 6 months later, you saw the retail home prices drop 3% year over year. But then our buyers became more bullish in early 2023, even while the retail market was slowing down. And that actually foreshadowed the rebound in home prices that we saw in late 23. But what I wanted to point out here is that our buyers actually in late 23 pulled back a little bit and became more conservative on their bidding. So they ended the year bidding about 57% of after repair value on average, which is, if you look at that benchmark, pre-pandemic benchmark of 60%, they're still being a little bit conservative. And so there is some sense that our buyers still are not super confident about the home price appreciation being very strong in 2024. And so that's something to look for. If you look at it by market, basically the green is where our buyers are more confident and are expecting home prices to increase more in the first half of 2024.
Yeah.
The blue is where they're less confident and they're hedging their bets in terms of pricing and pulling back on pricing. And so you actually don't see a super consistent trend here, but at least I don't. Maybe you guys see a pattern, but you do see certainly one thing that might be surprising is our buyers are pretty bullish again on the California market. There's a lot of green there. If you looked at this a year ago, the California would have been all blue. They were anticipating a correction there, and in a sense, a correction has happened. It's nothing major, but yeah, this is where they're anticipating pricing to go up or potentially be sluggish in 2024.
And Daren, you and I, go ahead, Eddie.
Well, the thing that I always feel like is like, where are these properties exiting? What is it? What's their future use? We have a lot of people that show up at Note School today that 2 years ago would have been buying rental properties, right? Or they would have been investing in syndications. Today, their math doesn't work. And so they show up at Note School because they're trying to find an asset that will cash flow. Now, this is a general statement, certainly not a micro market statement, but expenses went up about 65% and rents went up about 25%. So the rents didn't pace expenses. And now all of a sudden rents are declining. Once again, that's a macro number, not any specific market. But there's a Harvard report that we went over in Note School this show last week. And, it clearly is showing a decline in rents while expenses haven't declined. And so I question, when people are being aggressive or not aggressive in the foreclosure model, are they using them as rentals? And is that really dictating a lot about why they're willing to be more or less aggressive? That's just a question. Yeah,
that's a great question. And we see about a roughly 55% of folks who we just did a buyer survey are saying that their primary investing strategy is actually to renovate and then resell the properties to an owner-occupant type of buyer. And then the 40 to 45% are their primary investing strategy is renovate the property. Most of these properties require renovation; they're distressed properties.
Yeah.
And then renting the property. So a slight majority are fixing and flipping versus renting. But the renters have tended to be, we saw a shift toward renting last year, but now the shift is going back a little bit toward the fix and flip, I think because of what you're talking about.
Yep.
And we asked some questions around pricing as well. And those rental investors are a little less bullish on the market. I think because of what a lot of what you were saying is the expenses are going up and rents are slowing down.
Yeah.
So there's certainly a concern, and that certainly affects their pricing. When you're buying a property at auction right now, you have to think about what you can rent that property for, not right now, but in 6 months once it's been renovated and ready to go.
How are the numbers? You and I talked about this a minute yesterday, and we looked at percentage of sale as for ARV, after repair value. How does that correlate with the as is value as far as what they're ending up selling for at auction?
Yeah, the as is value, and I actually have a slide later on this.
Okay, well, let's just hold off on
that. I'll tease it here. This is, we're hovering around 50 to 60% of after repair value.
Right.
As is value, which as is value just is a little tricky because there's typically no interior inspection of the property, but it's hovering more around 70 to 80% of as is value.
Okay. Daren, here's an observation I'll make for you that I've noticed over the years. The longer it takes to foreclose, the more distressed the property is at the point of foreclosure, right? We're looking at properties on the interest-bearing side, just regular residential mortgages that are in default. They're 1,000 days delinquent. We're looking at the reverse mortgage market that went essentially about 2 years and couldn't foreclose. That is showing me that the inventory that's landing in foreclosure was very slow to get there. And that probably means the condition of the properties is more deteriorated. That's once again, a general statement, but I have noticed that pattern over the years.
Yeah, that's a great point. Yeah, and we're seeing that same thing with the extended timelines. And certainly that probably is factoring into this pricing as well.
All right. That's great data.
Yeah. So Fannie Mae no longer pretty, price correction. They used to be for 2024. MBA also aligns with that no correction scenario, no price correction in 2024. So I would say our buyers are, I think at least in some markets, our buyers are thinking there will be a correction, at least a slight correction, but so that's a little bit counter to some of these forecasts that we see out there.
Gotcha.
All right, jump into the distress market. And so this is how we kind of visualize the distress market as a funnel. You starting with your overall delinquencies, and then going, at least for us, the funnel goes all the way down to foreclosures, properties brought to foreclosure auction. And so that's the red there, the foreclosure FCBTA, that's the market.
Mm-hmm.
So if you look back in 2019, the fourth quarter, you had about 1.9 million at the top of the funnel. To the most recent data from MBA today is still from the third quarter, so it's a little bit outdated, but it's about the same, 1.9 million. In fact, almost exactly the same.
Yeah.
1.9 million. We have about the same number at the top of the funnel. But what's interesting is the further you go down the funnel, the less distress is produced from the same number at the top of the funnel. So if you look at that red foreclosure BTA brought to auction in 2019, about 48,000, 49,000 properties. In today, in 2023, we're seeing less than half of that. In fact, about 40% of that, about 18,000 properties brought to foreclosure auction. So the numbers are the same amount of distress at the top of the funnel is producing less distress at the bottom of the funnel. Now, some of that may be because more of these delinquents, I think there's several reasons for it. And you guys could probably speak to that in different ways than I could, but I think certainly there's more equity in the market. Homeowners are able to avoid foreclosure. There's a lot more loan modification, loss mitigation programs that are helping, at least in the short term, homeowners avoid foreclosure and making it to the bottom of the funnel. But I would imagine another piece is that some of these non-performing loans are being sold off at a discount, and so they can become re-performing again potentially, rather than go to foreclosure.
Yeah, generally speaking, I think as they progress down this funnel, the original lender is not keeping the loans; they're moving the loans to the secondary market. And I know you alluded to this when you started, but this is not you saying this. This is simply me saying this. I do believe there's some political motivation in it. As far as listen, the average delinquent mortgage is 1,000 days delinquent. That tells me that we're not really addressing the problem, right?
Yeah.
And
potentially kicking the can down the road.
You don't think we could do that, do you?
Not happened in history, though, right? Either.
So yeah, but the funnel. Your demonstration there is beautiful, and it does show us kind of what we've been saying, which is we are seeing assets coming over the mountain now at a rate that we have not seen from 2023. That seems to be a pattern.
When you say coming over the mountain, what do you mean by that?
They're those delinquent notes are now being positioned to get liquidated. There is definitively a pattern to that.
Yeah, we've heard some of that anecdotally as well. One thing I would point out here before I move on is that may align with that is if you look at the foreclosure starts specifically, there's 114,000 in 2019. That number in 23 is actually getting close. So we're approaching the same level of foreclosure starts, given the same level of delinquency.
Yep.
And we did see some big increases in foreclosure starts. It's in the third quarter specifically. Mm-hmm. It's a little early, I would say, to say if that's just a 1 quarter phenomenon or if we're actually seeing a little bit bigger trend happening there. But that's one thing to note. And the big question is, two questions is, will that foreclosure start volume continue? And if so, how much of that what will become of those foreclosure starts? How much of it will make it to liquidation, as you say?
Well, I would say that the first thing that happens is these foreclosure starts become an indication of these loans then get put out into the secondary market to get liquidated. The pattern of that I think is very distinctive. And we've got industry friends and counterparts in the business that deal at a significant level, and they're definitely feeling like 2024 is going to be quite different than 2023 in the MPL space. So for all of those reasons, then I'm agreeing with you, and it doesn't look like well, let me just say that there's a good inventory to be liquidated if you look at that bottom chart.
Yeah. Yep. We all are also seeing some consumer debt stress emerge. Credit card. This is a new seriously delinquent rate for all sorts of consumer debt. A few months ago, we were seeing this happen in the short-term delinquency, like 30-day delinquency. Mm-hmm. Now we're seeing it move to the 90-day delinquency bucket. And if you look at the green lines there, those are the ones that are really being affected. The credit card delinquencies, seriously delinquent rate is now up above pre-pandemic levels. The dark green line, the lighter green line, auto loan delinquencies are now up above pre-pandemic levels. We have not seen this. Of course, student loans is a totally different animal. That's behaving weirdly because of some of the government intervention. Yes. But we haven't, if you look at the blue lines there, the mortgage delinquencies have not, they've come up a little bit, but they're still well below pre-pandemic levels. So, but the point is we're seeing some of that, the consumers are getting a little bit more stressed. They're using their credit cards more and they're defaulting on their credit cards more.
Yeah.
And we would expect some of that to ripple out to mortgages as well. But it certainly has not happened yet. Now I'll transition to some of our own data, auction.com data. What we're seeing this is kind of relates to that bottom of the funnel, foreclosures brought to auction.
Mm-hmm.
We're still seeing on the left-hand side that foreclosure auction supply for our own platform running about 40 to 50% below or of pre-pandemic levels. So that means 50 to 60% below pre-pandemic levels. So it's still very low volume relative to even 2019, which if you compare 2019 to 2009, you're at a fraction of the volume that you were seeing in 2009. And similarly, the properties that don't sell at foreclosure auction become REO, and those go back to the foreclosing lender. That volume is running about 33% of pre-pandemic levels. And so similarly, there has not been anywhere close to a big wave of foreclosures in the wake of this national, emergency that we had. And some people feared that a lot of us did not know what was going to happen at that point. But I think we're very confident in saying now that there's not anything approaching a huge wave of foreclosures that's coming out of that event of 2020 and 21. And then if you look at it by state, now you do see more variation by state, and this has to do with the foreclosure process is controlled by the state law. And Eddie or Joe, you made the point earlier about the foreclosure timelines, and this aligns with that too. You tend to see the states with the shorter foreclosure timelines seeing more volume emerge, and all these percentages are relative to each state's own pre-pandemic levels. So for instance, Wyoming, which is a very low volume state, is at 100%. It's right at its pre-pandemic levels. Everything green is getting close to or even above, in some cases, its pre-pandemic levels. The blue indicates that the volume is very low. Florida is a prime example there, 21% of its pre-pandemic levels, almost 80% below pre-pandemic levels there. And this does have a lot to do with how the states are handling for the foreclosure process, as well as how aggressive foreclosure prevention efforts are in some of the states as well. So yeah, you see if you're looking for opportunities, you go to the green. Some of the Rust Belt Midwest states, but Florida, New York, some high volume states like Florida, New York, New Jersey still have very low volume relative to their own pre-pandemic levels.
Yeah, we are, and interesting for us, this is also somewhat of a pattern of how we see loan portfolios.
Yeah.
So it kind of grids up from what we see on the other side. So
yeah, and then here's our forecast going forward. We have 3 scenarios, and this is all centered around the red at the bottom of the funnel that we talked about earlier. What's going to come out at the bottom of the funnel, at least from an auction perspective, but it's going to be a similar volume that would be potentially coming out as NPLs, a similar trend. And the blue line there is historical numbers. Back in 2018, 2019, we're averaging about 250,000 properties brought to foreclosure auction each year. And this is market-wide, not just auction.com. Obviously, the numbers plummeted over the last few years. If we don't see any if we come in for that soft landing scenario we talked about early on, that's the green line. We would expect foreclosure volumes to basically flatline at what they've been, under 100,000 a year going out for the next few years. If we saw the yellow line is what we call a slow correction, where home prices don't really drop precipitously, but just kind of stagnate and maybe go down a little bit. And we would then see a rise in volume of these foreclosure auctions but still not even back up to 2019 levels, still about topping out at 200,000 there, almost 200,000.
Mm-hmm.
And then the red line is if you did have a more severe correction in the economy, housing market, that could trigger more delinquencies and more properties that are delinquent going through to liquidation because of lack of equity. So that's our forecast. I did want to show another slide that shows that forecast in bigger historical context, because if you look back to what it looked like in 2008, 2009, we were seeing 2008, 9, and 10, over 1 million properties brought to foreclosure auction market-wide. Mm-hmm. So even with that red scenario, it's nothing close to that type of volume.
With the level of delinquent loans, which means inventory of buying non-performing notes for us,
mm-hmm.
right? I've never seen such a stable real estate market with a good runway ahead of us of delinquent notes that it appears that we can buy.
Yeah.
Right. So people talk about, well, it's not going to be 2008. And I'm like, yeah, but it was really hard to figure out what to pay for non-performing notes in 2010 too.
Right.
Because it was, so every market has its challenges and its opportunities. And we're very optimistic about accessing inventory of non-performing notes this year. We feel like we're fairly well connected. We feel like we know where this inventory's at. And once again, we don't represent the whole market. Right. We just represent a little segment of the market. But the pattern,
I would say part of this is baked in, is that we're seeing more properties exit the distress funnel in the form of non-performing loans and not make it to our foreclosure liquidation, at least in the short term. And so our forecast kind of bakes into the fact that there's more of that that going on. And in fact, even the GSEs, I think in a lot of cases would rather sell off those non-performing loans than liquidate them themselves.
Yes, they would. They don't have the horsepower to do it. They don't really politically want to do it. Yep. And I think the reason is, Daren, is because that these are equitable foreclosures, meaning that their legal balance is leaving them equity. The difference between what they owe and what the property's worth, there's still room for them to do it. I think they've got to get a nudge, and that may not be something that you would comment on, but when the average delinquent note is 1,000 days delinquent, they're going to need a nudge.
Yeah,
something means me that they borrowed the money, it needs to get paid back, right?
Yeah.
So,
yep. I think that's all good. It's all good. I'll skip this slide because it's a little bit more of a technical slide that really, we've talked about the high level piece of this, how the market has changed. I did want to point out, and this is kind of a similar theme to what I just mentioned about more properties exiting the funnel earlier, mm-hmm. and not necessarily making it all the way to foreclosures. We are seeing an increase in the number of what we call pre-foreclosure sales. So properties that sell prior to the foreclosure auction, they're in default. The foreclosure process has started, in fact, and then they sell. The homeowner, because they often have equity, as you just mentioned,
right,
will sell. And so we're seeing those making up a bigger share of what we consider the distress market, the distress liquidation market. So that's an interesting piece. They're up to, in 21 and 22, they're up to 65% of all distressed sales, whereas back in 2017, 18, they were more like a third, 30 to 37% of all sales. So that things are shifting upstream in the distressed market. We are seeing equity, and I think this ties into you being somewhat confident that there's going to be non-performing loans available for sale, as we are seeing a shift in equity. Homeowners in distress still have a lot of equity, but it's come down. So this is data from Black Knight, or they're now owned by ICE. Yeah. A couple of years ago, 2021, there were 20% of loans that were in the gray or blue, which is either underwater or only with 10% equity. That has now increased to about 30% of loans that are either underwater, just specifically seriously delinquent loans that are underwater or have this marginal equity. So that is shifting a little bit. It's nowhere, again, close to, if you look back to 2008, 9, 10, the vast majority of seriously delinquent was underwater. But also speaks to the positive side of the coin you were talking about earlier, Eddie, that it's easier to price these, probably the non-performing loans. Given that so many do have equity still.
Yeah, definitely. It's a different formula in how we price them, but it's easier to do it. It's safer to do it. So, there's a lot more people, Daren, that we train today that aren't as deeply involved in the business as distressed note buyers that were involved in 2010. So it lets more people play because it's not so confusing as to kind of where you can operate safely. So
yeah, the environment is definitely more stable. One thing that the argument we're making to a lot of our clients who are mortgage servicers, GSEs, that the longer they leave these properties in foreclosure, this is basically trying to tell them the more risk of these properties losing equity. And so if you look on the far right-hand side, over the last 3 years, 21, 22, 23, this is specifically properties on our platform have been in foreclosure an average of 475 days. Now, this is just when they hit our platform. The 1,000 days you were talking about is when they become delinquent.
Correct.
But the trend is the same. Back in 2019, it was only 188 days. Now it's up to 475. And according to our analysis, these properties, during that time they sit waiting in foreclosure, they're losing an average of $7,000 in equity. Even though home prices are going up, these homeowners are losing equity because of the compounding effect of missing mortgage payments and the interest that is being actually added to the loan balance there as well.
Yeah.
So the worse this gets, to your point, I think the more motivation the servicers will have to make a decision about these kind of loans that are in limbo and either sell them as non-performing loans or go ahead and move forward with the foreclosure auction.
Well, the impression that we're getting is these decisions are getting made. Last year, they seemingly they weren't coming to this conclusion. It's our understanding that this year that they are coming to those conclusions. And that's why, we feel like the forecast is of available inventory of non-performing notes that get traded out into our world we're seeing a pretty good surge. Even though the chart doesn't show it, right? Because it's like, at the end of the day, what you're really showing there is there's not a lack of these loans available. It's a decision the servicer has to make and the people that own the loans as to what do we do with them.
Yeah. Yep. I think the telling piece is that funnel we talked about earlier. The top of the funnel is still, the volume has actually ticked back up and is on par with pre-pandemic levels. Yeah. I'm focused, of course, on the bottom of the funnel, but you're somewhere kind of in between the top of the funnel and the bottom of the funnel there.
Mm-hmm.
This is equity again. I'll skip over this one, but I think, Joe, this is what we finally getting to what you brought up earlier, which I think is really key in terms of trends in pricing these, how our buyers, most of our buyers are very experienced, have been doing this for years, decades, buying distressed properties. Either that, or even if they're newer, they know their market very well and how to value properties in their market. And so this is the trend we're seeing in how our buyers are pricing assets sold at foreclosure auction. You have that winning bid to after repair value that I talked about earlier, which is hovering between that 50 and 60%, but it's still, if there was an uptick in 21, if you go back to 2019, it was around that 60%. It's a little bit below that. They're being a little bit cautious, but still, fairly stable pricing there. If you look at the winning bid over what we call seller value, which would be the closest thing we can get to an as-is value, it's running like 75%. Now that has come, as you can see there, it's come down a little bit. Buyers are getting a little more conservative. They got pretty conservative back in late 2022 as mortgage rates were going up. So that's where it stands there, but certainly not. There was a little bit of a irrational exuberance taking place, and maybe it wasn't irrational. Maybe it was very rational given the market conditions. But back in 21, our buyers were willing to pay 91% of estimated as-is value to buy these properties.
Wow. That was the FOMO days, wasn't it?
I was waiting for Eddie to say it. I wanted you to say it.
Either FOMO or YOLO, right? YOLO.
Yeah, one of the two.
Here's some of that, basically the same data at a market level. This is percent of after repair value again, but the areas that are green tend to be lower priced. You can get a bigger discount on distress, basically, is a way of looking at it. The areas that are blue, higher priced, less of a discount on distress. You see a lot of the green there in the Rust Belt Northeast, where part of that is property. Number one, property conditions tend to be a little bit poor there.
Mm-hmm.
And number two, the foreclosure timelines tend to be a little bit longer, as Eddie pointed out earlier, which makes these higher distressed properties. But this is my last slide, guys, if you believe it or not. So
Daren, this was really, really good. And as I said, we have some viewpoints on it, but most of our viewpoints are formed by people like you. We're fairly impressed with this Harvard report. If you haven't seen it, we actually covered that in our
is that the Harvard Joint Housing Center, I think. And
we're not calling for sunny days on the multifamily side. And
by the way, I should point out auction.com we do residential, we do small multifamily under 5 units.
Yeah.
5 units. So a lot of what I've said is really focused on that market.
Correct.
Yeah.
And so to clarify, this is a residential position today. Of course, rents affect either rent houses or multifamily. Rents are, residential rents are what they are. And so there's some good data in there that I think that I'll be interested to see how you may apply it. Basically, this rent trend and the vacancy trend is what we're looking at. Daren, I'll say this in conclusion of our meeting today. We have had more people that have come to Note School and have converted existing rentals to seller financing in the last 12 months than I ever have seen in the history of Note School, and that's almost 25 years.
And so what's the reason?
Cash flow.
Okay.
I mean, you can carry owner financing at market rates or slightly above Fannie Freddie rates, right? More like non-QM rates. You keep all the payment. That payment is $1,000 more than rent on a starter home, and you keep all the money. Why would you not owner finance it? And people say, you missed the appreciation. Right? That's the argument, right?
Right. That's what I was going to bring up.
You get paid up front. Guess what? You get the money now.
Yeah. And we have certainly, we haven't ever surveyed this, but I've certainly talked to a lot of our buyers who will do the seller financing route. And, it's a hole in the market. And I think the GSEs and HUD are a little bit afraid of it, but you're leaving a big hole in the market especially when we talk about the properties on our site that are selling on our platform for $20,000 to $50,000. Their resale value when they're renovated is under $100,000, and so it's hard to find financing for those properties.
Oh yeah.
And so those are the type of properties that our buyers are doing seller financing and providing the market with this affordable inventory. That's a gap in the market. So but unfortunately there's some taint on that piece of the market, but I think I guess it means opportunity for folks like those who are in note school to do well. And I would say do well. They can do well by doing good because they're actually providing an inventory in a market that's missed out.
Our lobby efforts for the Seller Finance Coalition are pretty clear. Seller financing provides home ownership for people that otherwise would never experience it. And one of the clear examples of that is what you just said. Who in the world's going to make you $100,000 mortgage?
Yeah.
And so the reality is it does fill a gap in the market. And of course, we're just promoting people doing good business the right way, being compliant, not being cowboys and all that stuff. So there, anytime you have any market condition, you have some, but we think our trend in the industry is good. And we have just seen people just selling their rental inventory and owner financing it at a pace that we've not ever noticed in the past. We've done we've marked these up in what we call our deal labs, right? We've marked up so many deals and so much math that Joe and I are just pretty confident now when you go bring a comparison, now we're like, I bet you're going to be surprised. And it's kind of funny how often it is. So Daren, you are awesome. I know we ran long with you today, but it was so good. Nobody cares because nothing more meaningful to run a business than have good information. Your information is incredible. Thank you.
Well, thank you. And thank you for the opportunity to share with your audience.
All right, my friend. Take care. Thank you.
See you guys.
Bye.